So, welcome back to Everything Marketplaces, where we talk with founders and leaders from some of today's top marketplaces. So, this is episode 166, which is a really great group chat that we just had with Ryan Petersen, who's the founder and CEO of Flexport. So, Flexport is a supply chain and logistics platform that helps power global trade. Flexport has also raised over $2.4 billion in capital from top investors like A16Z and SoftBank. So this is a really incredible chat with Ryan, where we start off by going back to the founding story and first steps for starting Flexport. What some of the early challenges were, Ryan walked us through how Flexport has evolved and scaled. He shared some of his biggest learnings from fundraising. We also had a great group Q&A. I really enjoyed this conversation, and you're going to find it a great watch to the end. So Ryan, welcome to the group chat, and this has been a long time in the works. So I want to start off by saying a huge thanks for taking the time to join us in advance. So we have a lot that we're going to dive into with all of your incredible experience starting in scaling Flexport. But before we do, I think it might be great if you can start off by briefly sharing your background for those that don't know you.
So I've been an entrepreneur most of my life and started out in the early 2000s working for actually, I guess I had a job. I worked for my older brother who was the entrepreneur. And we were buying stuff in China, selling it on e-commerce websites that we would make in the US, and then also on other marketplaces like eBay and early sellers on Amazon when they first opened it up to third parties. And then after that, I moved to China to run the supply chain for that company and continue to build the websites and do other stuff. It's a real scrappy company. And then I my brother and I, we spun out from that. We started importgenius.com, which is a data service for importers and exporters. We sell data on imports and exports. And then from there, spun out Flexport. My brother also is a marketplace founder, started Build Zoom, which is a marketplace for remodeling. And now he's got a half a dozen other marketplaces. And maybe he'd be a good guest speaker for you someday too. But so I focused on Flexport. He focused on all the other kind of more traditional marketplaces, traditional online marketplaces. Flexport is a combination technology company, logistics service provider. We provide a platform for global logistics, make it easy for companies to place orders to their factories all over the world, and then get those things delivered wherever they need to go by any mode of transport, from factory all the way to customer stores. There are marketplace elements. We don't see ourselves as a pure marketplace, but every transaction that we do has multiple vendors, and we try to run sort of small sale procurement / marketplace processes to get the best rates out of those vendors on carving a transaction, a freight shipment into many legs, and then each leg needs to have a great set of providers who do great work for us to get ultimately the customer value prop is better visibility, control over your freight, lower prices, help you optimize your working capital, your inventory, and then more compliance, better services to actually understand what's going on with all your products. And ultimately for these companies, the product is the lifeblood of the company, so they need to know where the stuff is. And the traditional industry is pretty bad at that. So that's how Flexport differentiates, is really how the tech, plus I think we have better people. We've managed to attract better talent to this industry than traditional freight companies by showing that it's interesting, that there's a technology element that you can actually transform this industry. It becomes a self-fulfilling prophecy. Then you get better people into the team, and the team does better work, and you win because of the team more than anything else.
No, that's a really great background, and you mentioned a lot of topics as well that we're going to get into in more detail. But I guess, going back to the very beginning, what were the actual first steps, that you took to start Flexport at the time?
So we're now 15 years since I first started working on it, but we've only had customers for 10 years. So it tells you it was a long time to get going. Heavily regulated industry, so I had to spend a lot of time researching the regulations. There's 43 government agencies that are taking interest in imported products. So you had to get licensed by Customs and Border Protection, Federal Maritime Commission, basically before you could get started at all. And that's you have to clear an FBI background check. That took several years. So getting that going I don't think that's a real barrier to entry. I mean, someone who's determined, I did it, other people can do it, but definitely harder than just starting some SaaS company or something. Like, it takes a long time to get a minimum viable product in place. And then knowing whether to go through all that was hard. So, you don't want to do all that work if there's no customers on the other end. So one of the things I did was kind of confirmed that there would be demand if the product existed. And I did that using my very advanced Photoshop skills, made a fake website, fake app, and then put it out on the web to see if people would sign up. If this service did exist, would people sign up for it? And I started getting hundreds of signups before we had anything. There's no app, no license, no business, just me. And that was confirmation that, okay, I should in fact go through this process, get licensed, go through the FBI background process, et cetera. That it was all about 4 or 5 years before we ever, yeah, did anything. And then once we got licensed, I applied for Y Combinator, like right after the license came through. And kind of the rest is much more publicly known about our story, getting a more kind of traditional venture capital route. But that was the first time raising venture capital. I've been been an entrepreneur for about 14 years or so before I ever raised any venture capital. And I think, yeah, there's pluses and minuses. If people want to talk about that, I'm happy to talk to it.
Yeah, I mean that would actually be good to get into a little bit. So I guess I guess what kind of gave you the conviction that you thought like Flexport would work and to take on capital?
It was, the market's just so big, the competition so weak, in my opinion. That's just like objectively the if you look at the top 100 freight companies, freight forwarding businesses in the world, none of them were founded after the web browser was invented. So it's just like an industry, and it's capital light. It's asset light. You don't need to own. This is an intermediary. You don't need to own the ships and the planes and in some cases you want to have warehouses, but you really don't need it to get started. And so you can, yeah, it's a very attractive industry, very fragmented, no tech anywhere to be seen. I'd been a customer of these companies for a long time, so I knew how bad they were. I knew how much money we had to spend with them. I thought they all had mediocre people. I mean, that's just rude because we've hired a lot of their people, so I don't want to overstate that. But we've hired great people from the industry. There are great people in this industry, but in general, the average person, they're just kind of like a DHL. Well, it is DHL, literally. Call the 800 number and tell me your experience. It's not that great. And so I knew we could do better on the talent side. I knew we could do better on the tech side. I didn't have the expertise, so I had to go figure out how to actually execute. But yeah, and then all the signups we were getting of big household names were signing up, as well as like lots of small Amazon sellers and stuff like that. So it was pretty obvious from the beginning that like if we can do the job, there will be demand. It's still, a hard job to do, and like it's become more clear. If I'd known how hard it was, I mean, I don't think I would have been so naively optimistic about it all. Like it's being able to move cargo around the world is not easy.
Can only imagine. So I guess on that note too, just for a little bit of context, how many kind of like participants are involved in each transaction in order to kind of make it possible?
Well, a typical transaction will have a dozen or more companies involved. And so that's kind of Flexport's job. You have the importer and the exporter. And so that they connect, we don't make that connection. We don't introduce them to their factories. You got to bring your own factories, but the average merchant the average importer will bring on, in the enterprise segment, brings on around 18 factories to the platform. And then they place orders to those factories through our system. And then we execute it on a door-to-door basis. You can just count them. So the importer and the exporter, then the trucking company at origin will bring it to a warehouse to get consolidated, put into a container. And that's a trucking company that brings another trucking company brings the container to the port. The port itself is a company, an ocean carrier. So I'm at 7 companies, and I haven't left the origin country yet. And it's kind of a similar number on the other end. Then you have a fulfillment provider, a last mile carrier for if it's to home delivery. You have a bank and an insurance company. And sometimes there's intermediary layers of brokers and stuff in between you and the actual asset owners in these cases. So yeah, it's 12 to 25 is the number of companies involved. And that's our job, is to coordinate that complexity so that the importer doesn't see it. Make sure we have great vendors on the ends of those transactions on each leg. And there are marketplace-like dynamics. I mean, we try to avoid pure marketplace Like in our industry, for example, the most obvious thing is sort of like a kayak. You would like to have an ocean freight market kayak for ocean freight and find the cheapest freight. Mm-hmm. But the ocean carriers are really allergic to that. The people that own the ships don't want to be put into a transactional sort of race to the bottom on price. So you have to understand that all the needs and try to see the world through the eyes of these participants and make it in their interest to come onto your platform and participate.
And I guess, as far as like, with so many different participants in the transaction, so many different kind of problems and inefficiencies, I guess, as well. How do you think about, sequencing when it comes to, solving some of those problems for the customers?
I think the sequence is for me, it's demand led. If you have customers, that generally the vendors will show up, and they'll be happy to follow your standards the bigger and more important you are as a customer. So, for example, with our trucking technology, we did that like fully manual for the first 3 years of our business or so, where we would just email truckers and assign loads to them by email, and then they'd deliver them and they'd communicate back to us, and our team would sort of update the app that kept the customers informed. But it was very expensive. I think the time study we did showed it was costing us 42 minutes of labor for each load that we dispatched in this way. Um, and we just did that for like many years. We got pretty big, and then once we had some scale and we became 20 or 30% of the freight, or sometimes more, for these trucking companies, then we said, okay, then we developed a software application for them with mobile app for their drivers and a dispatcher app that allows them to assign the loads to the drivers. And we said, hey, if you want to get business from Flexport, you have to use this software. And at that point, they were happy to, because one, they didn't want to lose all of their revenue, but two, it was saving them time on these transactions too. And so it's demand, but it's always demand led. Like if you have the customer, the vendors will come. In fact, what do we say in freight forwarding? We say he who has the freight gets the rate. Like if you have the customer, then the vendor will come and get the price that you need to keep the customer.
And I guess too, we're kind of bouncing around a little bit in the earlier stages, and we could probably have an entire chat as far as how Flexport has evolved and scaled. But could you kind of just walk us through, I guess, like from a high level, the various stages of Flexport as you've scaled, and maybe some of the kind of key points in growth.
Yeah. I mentioned the first customer, the early days, getting that first funding. In the beginning, you have a real chicken and egg problem in this business, like any marketplace. Because if you don't have any freight, you don't get good prices. And if you don't have good prices, you don't get any freight. And that's to say nothing of all the problems of global complex coordination of all these vendors. Even just on the port to port leg of the ocean freight piece, was the original hard problem we had to solve. Um, we went, One thing we did was we just went and talked to users nonstop. And I got a whiteboard and asked them, hey, what do you want your control panel to look like, your control tower for your logistics, like your global freight? How would you like to represent that data if you were to work with us? And we whiteboarded, and we had the head of supply chain for one of the world's biggest watchmakers. We drew with him on the whiteboard what that would look like. And, anything that's late would turn red on this map. And there's my list of exceptions and work that I need to do. And then we came back a month later and we had built that software. And then he was like, wow, I remember the line. He was like, you turned me into a computer programmer. I gotta buy some freight from you. And then, when we got his request, he was like, if you can hit this target price, then we'll move a bunch of volume with you. And that target price was half the price that we were buying freight for at that time, because we were so small and we were nobodies. But at least we had a rate, that target, and we had a customer that if we could get this. And then we went out and found it. He wasn't asking for crazy prices. We were just so small that we didn't have good offers, a good supply side procurement prices. So then we took that, and over the course of like 60 days, went and found a carrier or another vendor, I forgot, that would match that price. And we went back to him and we got the deal done. It was very helpful that it was sort of asynchronous. I didn't need to have instant liquidity. I didn't need to be able to match that price in that second. I had a couple months to go figure it out, which I don't know is the case in every marketplace business. But we had time and trust. But it really started with that conversation of understanding the customer problems, and getting them to commit that it's a lot of if then statements. Like, if you could do this, then I would buy. And you should never, in the early days, I think I talk about this sometimes, like I call this entrepreneurial sales, founder led sales. Like, you should never get a no ever. It's not acceptable. You get a yes if, and the if is something that is impossible. Therefore, it's effectively a no. But at least you're getting the if, and then that's driving your product roadmap, because 1% of the time, 5% of the time, you'll sit down with your team and go like, actually, we could pull this off. Like, here's what we'd have to do. We could build this tech, whatever. We could go out and find the carrier that would match that price. But that's very different than at scale when you have like now, Flexport has a very relatively mature sales organization with probably almost 200 salespeople around the world. I don't want them out there going, yes, yeah, I'm happy for them to get to know so that they can go find the next one and work on that deal and don't waste cycles. And like, we're not trying to modify our product based on an individual, like what we have teams of people that are out here talking to customers and figure out the customer feedback, but that's not my sales team. I want them selling, and sure, bring back the reasons why you lost the deal. But at the end of the day, I'm not trying to get that. It's the early days of a company. Really needs to be the founder. It's very dangerous to hire a salesperson when you haven't yet got escape velocity of product market fit, because you need to be using those cycles to improve your product and learn from the market.
That's a really great example of talking to your customers and founder-led sales. So I guess on that point too, because we're always discussing founder-led sales here in the community. How long did you lead that yourself with Flexport?
He's not technically a co-founder because I worked on the business for 5 years before he joined, but effectively treated him as a co-founder. One of my early business partners led sales for me, and he did more of this than I did. He was in more of these exploratory, but I trusted him to be basically a founder. So yeah, I did hire, but I didn't hire him as a salesperson. I was like a business partner, a real sparring partner on understanding the business, exploring things, like really good at asking questions and learning and bringing that feedback to our tech org. So I was lucky to find someone like that, but it's pretty rare. I think you generally have to assume that you're going to do it yourself.
Certainly. So, and then another thing that I wanted to talk about, which you've mentioned a few different times, but as far as Flexport being more operationally complex and in nature, probably compared to some other kind of consumer or even B2B marketplaces, what have been some of the biggest, I would say, learnings around running Flexport being so operationally complex?
You don't make money doing easy things, and it's very hard to manage a lot of people. They're very expensive. We're lucky that we were born in an era where capital markets were booming and we could raise capital to fund the journey. You have to be able to get your revenue, your profit, your net revenue, your gross profit off your transactions growing, disconnected from your headcount. If it's not, you don't really have something that's special. And I think we waited too long to focus on the automation of work. Now that we focused on it, the results are amazing. We also, too many people in your business means, it's very hard for a large group of people to focus on more than one thing. I think an individual entrepreneur is pretty good at that. I'm maybe not focused, but getting lots of things done. And that becomes really challenging as you get a big company. They want really simple messages, and next thing you know, you're delivering a simple message, and they're forgetting this other thing that's obviously important. And that's just like human nature. It's very hard to get a large group of people. Large groups of people want to row in unison and go in the same direction. And when you have a big company, you need to be able to do lots of things well. And so you'll quickly find out that you're becoming bureaucratic and not good at a lot of stuff, and you have to spend all your time fighting the bureaucracy and putting in processes to allow for teams to have different goals and execute things. But yeah, a lot of hard learnings. I think you're much better off if you can keep your team lean as do not hire anybody until you've got product market fit for sure. And even then, make sure that you're growing your profits way faster than your headcount.
Yeah, so on that note, I actually want to ask a question from a founder that was sending me a message, which is looking back now, what were some of the early key hires for Flexport?
Oh yeah, I mean, so many. I think my very first hire was a former investment banker, but like a really young. I mean, I think he had done 2 years of investment banking out of college. He was a really, maybe 24 years old or something, and just worked really hard and had a good attitude and was willing to do anything to make the company successful. And so just having like that kind of jack of all trades who's smart and hardworking and will set the tone for everybody else. So like, hey, we're gonna put this above anything else in our life, which is harder to do for people with families and stuff like that. It's impossible. You should not do it if you have a family, but like that's the benefit of young people with no families. Like they can just do that. And he put Flexport first, and then that set the tone for everybody else that joined. And he could kind of offload lots of stuff to him that I didn't want to do. And there was nothing not good enough for him, work wise. Early technical hires were super important to set the tone and set the bar of what types of talent we would require, what skills you need to come work at Flexport. From an engineering perspective, that sales hire I mentioned, hired a great ex-consultant, a friend of mine though. I don't really think that highly of the consulting firms in terms of joining companies because they just don't have enough experience doing the work. They're much more used to advising people and doing work. But I knew him for a long time, and he had a lot of background in freight forwarding on the consulting side. So he could teach us like at an intellectual level how these things work that we didn't quite understand. So getting someone from the industry who's an insider that you trust. Still, I think we're too slow to hire industry expertise, um, and especially tech people from the industry. We like just look down so much on this industry that we didn't hire people out of the technology orgs of our incumbents. And that was probably a mistake. Like, I don't think you hire those people and put them in charge, but you want to have their voice. They know there are certain aspects of data architecture, data modeling that are industry specific that we could have avoided probably years of tech debt if we would have had more experience in modeling these transactions. No, yeah, we're probably too arrogant in that regard. We should have hired more. Once we hired a few people, we're like, oh, this makes tons of sense. We should, set things up the wrong way in the beginning.
Yeah, and I guess what's the Flexport team like today?
Worldwide, we're about 2,000 people. 400 of them are software engineers. I think of that, the biggest office is in Amsterdam. But we don't, not by much. We have like 6 offices that have 150 people in them around the world. We started in San Francisco, but San Francisco is now like the 7th largest office in the company or something. It's not a great place. So we've been growing everywhere else. China is our second and third biggest offices are in China. And then it's probably some of the, Dallas, Chicago, New York. So we're pretty globally distributed. I think we're in 15 countries now where we have our own people, and our own employees in 15 countries, something like that, 15 or 16.
Pretty incredible sense of scale you're at today.
Well, it's hard. I travel 2 weeks a month plus 2 days a week on the weeks I'm not traveling. So I have to go out there. I mean, this is amazing. Like, the video conferencing has made the company way. I don't know how you'd run one of these companies back before video conferencing.
Yeah. So we're going to get into questions here because I'm getting messages from founders, and I promise them we'd save some time for the group Q&A. But right before we do, so you've raised what I believe 2.4 billion from some pretty awesome investors like A16Z and SoftBank. So I guess looking back, what are some of your biggest I would say like learnings from fundraising?
It's a very risky process. It's a total nightmare. And I think you should avoid doing it at all costs unless you have to, unless the company's going to die if you don't. Don't do it because you think it'll be good, or do you think you're hot and everybody wants a piece? Like, don't don't get full of yourself, because it can go sideways really fast. I've had three different, two different, at least two fundraisers go completely sideways and had to get rescued by a previous investor. Thankfully, Founders Fund is awesome, and they did that on good terms for us. But it can be, even a hot company, and the thing is about venture capital is that it's a great job to be a venture capitalist. You make a lot of money, millions of dollars a year. You don't have a real boss. Nobody can measure your performance except on a 10-year cycle, and even then it might be luck. And you don't have to be anywhere. You can do it from anywhere in the world. It's like a really great job. So the number one objective, therefore, of a venture capitalist is not to lose that job. And the way that they lose the job is to be seen as being dumb or crazy or doing bad deals. Not by doing bad deals, it's by being seen as doing bad deals. And therefore, you can't take a lot of risk. You have to reference check. You have to check everything you do with your peers and with your, whether that, and often it's, you don't want to do that internally, because then you're like, oh, this guy doesn't know what he's talking about. So you do it with your friends at other firms, sharing notes, colluding, we call this. And then that leads to regression to the mean. It means that you think you're talking to three different firms that are independent. You're running a bidding process. Actually, they're all talking to each other and setting the price. They work with each other nonstop. They're all friends. They all hang out all the time. Um, and it is a very dangerous landscape for an entrepreneur to charge into, thinking that they're the best. You're not the best. You're up against literally all the best companies in the world are your competition, even though they're not in your industry. That's who you're competing with for mind share and ultimately for the dollars of the VCs. And um, you should just avoid that world as much and as long as you possibly can. And if you do raise money, treat it like it's the last money you're ever going to get. Keep the headcount super low. Keep the and that this is not what I did, so it's easy. Well, I ran many companies for a long. I ran companies for a long time with no venture capital, and made them super profitable. And I think the flip side of that is, like, you can get these hype cycles in your favor if all the VCs like you, then and there's a herd mentality to chase into your deal, then that can be, you can use this to your advantage. And then second is and related, how do you do that is you need to be able to show crazy hockey stick graphs. Like, when you're a VC, you see nothing but incredible graphs up and to the right. If you don't have a hockey stick, like true exponential growth, then, like, don't bother. They're not going to get excited. And so you need to be able to have that graph. And how do you get that? Well, for one, don't share any metrics with the VCs ever until you're really fundraising, because once you've shared a metric, now you're expected to make that metric that you shared go into a hockey stick. You can't just find whichever metric does happen to look like a hockey stick and use that, which is, of course, the answer, is find something in your business that looks like that and then claim that that's the most important thing. And that's the one you've been optimizing for. And that's what they should pay attention to. Well, once you've shared metrics in the past that weren't that one, you lose the ability to go back and ex post sample the variables that are going like that. Two is, when you find something that is working like that, you want to be raising in that window of like 90 days. And you show that for 30 days it's gone like this. You call the VCs, you go, hey, we figured it out. We cracked the code. Look at this. And then you need to be able to sustain that exponential growth for another 60 days so that you get the funding done. And then after that, back to doing whatever's best for the business. But you've got to be able to have this hockey stick. Also, whenever you present a graph, the easiest way to make a hockey stick is just make sure you tighten the aspect ratio on your graph. So if you compress it sideways, it'll look steeper. And so to do that, you can put always put some text on one side, like a bunch of bullet points about the graph. And then that way the graph is only half as wide. Or you can put three graphs on horizontally next to each other and they'll each look really steep. The human brain is very susceptible to these tricks. So you need to use them to your advantage. And then, yeah, making sure that the other thing is, if this hype cycle, that they're reference checking you. So the best thing that can happen is that a VC, you're looking for an outlier, but the process in itself is leading to regression to the mean because these guys all talk to each other and they get to regression to the mean. But you want an outlier, you need somebody who's going to value you more than everybody else. Um, that means actually, in a pure play kind of auction, the more participants you have, the more likely you are to get a high price. But when all the auctions participants are colluding with each other, then actually that's not true. You don't want a lot of people at the table. You just want a few people who will really fall in love, and then when they go to reference you with other people, like no one's ever heard of you, that's like ideal because then they feel like they're doing a great job. They have proprietary deal flow. They're sourcing, a hot company that no one knows about. Man, I'm the best. People want to think that they're the best, and then uh, they can let themselves get carried away and value at a high level. No investor wants to be in a competitive dynamic. They'll avoid it like the plague if they're good. So there's like you think like, oh, I'm going to run this process and get 12 funds at the table and I'll take the highest winner. Like actually, that's probably going to scare away the best funds. And yeah, there's no right answer. There's no generic for this though. Every company is different from a fundraising standpoint. But my general advice would be try to avoid it, stay away from it.
Yeah, no, it's certainly nuanced. So you got a lot of head nods here too from founders. So well, cool. We're gonna jump into the group Q&A. Hey, Ben, do you want to come on? I saw you raise your hand.
Yeah, sweet. Thanks so much, Ryan. I think one question that I've got is, I guess, the balance between product market fit and building something that people love, and of course growth and reaching product channel fit. I'd love to hear more about like how like Flexport went about kind of like balancing that. So yeah.
Well, we were pretty lucky that we just had like runaway interest in our offerings from the beginning. I think the more interesting thing was that we weren't necessarily getting the right kinds of customers early days. Like our online sign up flow is like we were getting dozens of signups every day, but when you actually, and they would spend some money, but they'd turn out to be really difficult customers to serve. And so one of the important things that we did was not only just talk to all these customers, but talk to lots of other customers. I'm not anti-VC, by the way. My VCs have been amazing. We were lucky to raise on good terms coming out of Y Combinator and on subsequent rounds too. And what we went through our investor base, but if you don't have investors, you can do this through your friend base or your networks, whatever, classmates. But you go to everybody, sit with figure out who they're connected to. LinkedIn is pretty good for this. Then who do they know that would be relevant for you, and write them an email that they can send, make it super easy for them to send the email out. And so we started doing outbound prospecting that way, and realized that actually outbound, we were getting much more, the opportunities we would generate that way were much better fit for what we wanted to do, like bigger companies that had some scale that weren't so transactional. Like our early customers, we imported like a guy who bought a bouncy house in China for his kid's birthday party instead of going to Walmart. I mean, like, it was a pretty crappy customer base in the beginning. And then we started talking to, like the Warby Parkers and the people that are investors that invest, like real brands, and then understood that like, oh, actually, like what we have on offer is not good enough for those brands. Okay, let's go work on that and build the right product so that we could actually, and again, more if-then statements to win business from those guys. So I think it's dangerous to just take away, whoever signs up for your platform. And it's dangerous to think that just because you have a lot of signups that you have product market fit, like not necessarily that they're the right customers. And you have to really understand the economics of it all, the financial unit economics of each transaction, if you have labor costs involved in servicing them. and those can be really hard to parse out. And I would say we definitely underinvested in our accounting function for a long time because I found accounting to be boring, and that was, most of our problems are a reflection of personality flaws of the founder. And since we got our accounting house in order, dramatically improved the business because you got to have base level unit economics that you trust, so then you can scale it.
Awesome. That's a great question. Hey, Katerina, do you want to come on?
Thank you, Mike. Thank you, Ryan, very much. This is so interesting. Quick question from me, especially related to nearshoring. With the increasing shift towards nearshoring and the redrafting of these traditional trade routes, what are maybe your predictions for the next major developments in global trade infrastructure? Like, what kind of products or companies will we see emerging to support these new trade routes?
I think it's a little bit overblown. Ocean freight is so cheap. We're overthinking this. I mean, it's cheaper to ship ocean freight from Australia to the United States than it is to ship a truck from Mexico to the United States. So, it looks on the surface like, okay, we're going to stop like China trade war. Government's going to crack down on China. We're going to have tariffs, but like, I don't think that necessarily means that you move the manufacturing to the U.S. or Mexico. Mexico has good labor costs relative to the U.S., and relative to China even, but the logistics is so bad, and it's not their fault. They just have crappy geography. It's a very mountainous country. There's not a single, the United States has more navigable rivers than the rest of the world combined, and Mexico doesn't have any navigable rivers. And navigable rivers are cheap freight. We move freight every day down the Yangtze River in China, down the Mekong River in Vietnam, up the Rhine River in Europe, but Mexico won't be able to do that ever.
Hey, Ryan, I actually had a question for you that I wanted to ask. With operating in so many different markets, with so many different world events too that kind of impact your business. How do you stay up to speed on everything?
We have a great team all over the world, so they kind of are pretty good tentacles for finding out what's happening out there in the world, talking to customers and seeing what's impacting them, talking to our vendors, our carriers, asset owners. I think these things are pretty good. We have a news Slack channel where people post industry news. It's kind of interesting. It's interesting to see what people think is interesting anyways. And usually that is getting you as much coverage as you probably need. I think the news is you can over index on stuff that is being written there. And it's often we have a better perspective, like based on our industry knowledge of what's happening out there in the world. And then, yeah, I like YouTube a lot. And I have the YouTube algorithm knows me well, and it shows me stuff that I want to see.
Hey, Danny, do you want to come on? So raise your hand.
I wanted to dig into something that you said earlier on in the conversation. You were talking about try to keep the team as small as possible for as long as possible. If you were to start Flexport again, given all the tools that are available now, these AI, like every day a new AI tool comes out, do you think would there be any specific team that you think you'd now be able to keep much smaller? And how do you think the tools that you have at your disposal right now would change how you'd scale Flexport?
Yeah, to be honest, a lot of it is probably investing more in the accounting function, like I mentioned earlier, so that you can really drill into the unit economics. I think and it's more, where do you point your engineering effort towards automation of work? We built this like crazy powerful workflow platform to manage the transactions and then automate them, but we only got really serious about that in 2019 or 2020 even. So your first customers came in 2014, and for the first 6 years we were just focused on the user experience. And it turned out a lot of the problems in the user experience come from lack of standard workflow and structured work and data there. So it's more about like, where do you point your resources? I do think we'd have better unit economics now and less people if we'd started that. LLMs are incredible for this, by the way. I think we're gonna be able to improve our margins by like 35% or something. Under the net revenue line, have 35% more of it turn into profit over the next 2 years, just from being able to use AI to automate the workflow. The early tests of this are really crazy. So yeah, I think you could build a better version of Flexport with AI. I mean, we're going to build a better version of it, but if we'd had that, if only we'd invented large language models and had the NVIDIA H100 10 years ago, we'd have been a great business.
Hey, BJ, do you want to jump on? We'll try to get in another question here.
Yeah, sure. Thanks a lot. Ryan, it's great to meet you. Thanks a lot for your time. I know it's valuable, so we appreciate it. My question is more on the future of where you're going. I know kind of in the early stages of a business, you're trying to decide how deep you go versus how wide you go.
Mm-hmm.
Last year, you've kind of expanded into the fulfillment side, getting into your partnership with Shopify, getting into Deliver. Quick question about just kind of how that's been going, and then kind of the future for that, and then what are the additional things you're kind of going upstream or downstream, trying to kind of consolidate into your business?
Yeah, we expanded last year. We acquired two, what's now called Flexport Omnichannel, with Shopify Logistics and Deliver. We acquired that. We also acquired Convoy's technology and assets. Convoy's a truckload brokerage. So those are the two big acquisitions we've done in our history. We did them both last year. Probably we're done with that for a few years as we digest that and go integrate them and bring that. In some cases, actually, those are both kind of turnarounds. The Deliver business, the Omni, we rebranded it, repositioned it as Flexport Omnichannel. We added a B2B layer to it so you can deliver to your stores, not just to consumers' homes. We've done about 50 retail partnerships with different marketplaces and retailers to make it easy for these e-com for the customers to sell across many channels. And then, yeah, dramatically, it was run as a third-party network. It was very much a marketplace business. You had like all these little mom and pop fulfillment sites, 40 of them, I think, when we acquired it. The service was pretty bad. They weren't at scale. We have it as split inventory across many sites because none of them was big enough. So we rebuilt that across 5 massive sites. It's probably too big, if I'm honest. The sites are so big, like 1 million square foot each, 5 million square feet in the network. It's hard to fathom how big that is. It's a half a mile. Well, they're half a mile long, and the Pentagon is only 0.2 miles long, just for context. I mean, these are very big buildings. That you drive operational scale in there, you drive quality, you still have the ability to do 2-day delivery. And we've transformed the P&L, the omnichannel business. We're still working through it. It should be profitable. I was aiming to get it profitable in November and peak this year. We're still working through if that's going to happen, but it'll be profitable next year. Convoy also will be profitable next year. Then we'll talk about global expansion for those businesses. Today we just do fulfillment into the US. Really like to bring that global. Love it. Love the idea that you just take a small e-com brand and you go, hey, why aren't you selling on Flipkart or Rakuten or Amazon Germany or something, and just like one click almost get your cargo, get your products positioned around the world. We have all the capabilities for that, except for we haven't brought the omnichannel business for the last mile piece or the integrations with the marketplaces. But yeah, I think we're more or less complete. It's about bringing all the products that we have. I'm not trying to spread more horizontally, although taking some products we have into new geographies and then just general geographic expansion. Like we shipped freight to and from around 100 countries, but we only have people in 15. And once we put people on the ground, you see that the growth happens much faster. So I'd like to be able to accelerate that with it's basically a couple salespeople, biz dev, ops, kind of like a little tiger team that can go and just get a market to accelerate. And yeah, we have a long list of countries that we'd like to go to in the next couple of years. But it's bringing existing products to new markets, and then refining the existing products with better tech and value prop rather than new products that we have to invent.
Awesome. Thanks. So we're almost out of time here, but yeah, thanks for joining us again, Ryan. So this is such a great chat, and I know we bounced around a little bit, but cover lots of ground here, and this is a highlight for us all here in the community. So we really appreciate it. And I did want to ask my kind of closing question that I typically ask, which is if you could go right back to before you started Flexport, what would you tell yourself?
What would I tell myself? Yeah, invest more in accounting. Accounting's not as boring as it seems. Make sure you really understand the unit economics of every transaction, and your job is not to do things. Like in our case, we're not here to move. We don't move freight at a loss. Like that's not our job. Like we're going to make money on everything we do. And I think there were too many cases where you're just like trying to get brand names or win some customer and accept like, oh, someday we'll make money on this thing. And it's like, it's almost always a fiction that you tell yourself, like you can't make money on it on this transaction, just like find a different transaction and do that one.
That's going to be a great parting advice for us here. So, and then last but not least, time for a quick plug. Where can we keep up with you at?
Oh, I mean, I post on Twitter sometimes, but I'm trying to, so political these days. So I'm more interested in business. So I refuse to participate in LinkedIn though. So it's going to be Twitter or nothing.
We appreciate it.
Okay. Take care, everybody. Good luck to you.